Hey, let's talk about investing. If you've ever felt that it's this big, complicated world that's only for experts, well, this is for you. In the next few minutes, we're going to break it all down and build a simple, clear roadmap to get your money working for you. Let's jump right in.
You've probably heard this quote before, and for good reason. It's basically the secret sauce to building wealth. All it means is that you start earning interest not just on your original cash, but on the interest you've already earned. It's like a snowball effect for your money.
Okay, so knowing you should invest is one thing, but figuring out the how, yeah, that can feel totally overwhelming. The good news is there's a really clear path forward, and we're going to walk through it together.
So here's our game plan. We'll start with the why, then we'll look at the basic tools you'll need. After that, we'll find a strategy that actually fits you, learn what traps to sidestep, and then wrap it all up with a simple 3-step plan to get you launched.
Okay, let's start with the big picture. Why is investing so crucial in the first place? Well, it's all about putting your money to work so that one day you don't have to work quite so hard for your money.
And if you're feeling like a total rookie, you are definitely not alone. Check this out. According to an Investopedia survey, 2/3 of adults in the US don't feel like they have advanced investing knowledge. So what that really means is it's completely normal to be starting from square one.
Now here's the real danger of not investing. Every single day, there's this quiet, invisible force called inflation, and it's basically eating away at the value of your cash. That cheeseburger that cost $7 last year, it might cost 10 this year. That means the money just sitting there in a savings account is actually losing its buying power.
And this is the engine that fights back. Think of it like this. Your first investment is like a little worker. Compounding is when the money your worker earns also becomes a worker and starts earning its own money. Over time, you build up a whole army of dollars working for you, and that's when your growth can really accelerate.
All right, so you're convinced, but what do you actually go out and buy? Let's talk about the two most popular and beginner-friendly tools out there: mutual funds and exchange-traded funds, or as you'll see them, ETFs. You've heard that old saying, don't put all your eggs in one basket, right? Well, investing in just one single company is kind of like putting all your faith in that one basket. If it drops, you're out of luck. But funds are like owning dozens of baskets all at once. They instantly spread your money across a whole bunch of different companies, and that dramatically reduces your risk. We call this diversification.
So what's the difference between these two types of funds? Well, the main thing to know is just how they trade. Mutual funds get priced just one time, at the end of the day. ETFs, though, they trade all day long, just like a regular stock, so their price can change from one minute to the next.
A fantastic starting point, maybe the best, is something called an index fund. It can be a mutual fund or an ETF. And its job is super simple. Instead of trying to be a hero and beat the market, it just aims to match the performance of a market benchmark or index, like the S&P 500, which is really just a list of the 500 biggest companies in America.
And hey, don't just take my word for it. Warren Buffett, one of the most successful investors in history, has said for years that for most people, the simplest and best strategy is to just own a low-cost index fund. It gives you that instant diversification without a ton of effort.
Okay, now let's see how we can use these tools to build a personal strategy. Your approach really should line up with your goals and, how hands-on you actually want to be.
This brings us to a huge choice: active versus passive investing. Active managers try to pick winners and beat the market, but that means you're going to pay higher fees. Passive investing, like with an index fund, just tries to match the market. And here's the kicker. Research shows time and time again that over the long run, the vast majority of those active funds actually fail to beat their simple, low-cost passive competition. Now, inside these funds, different managers follow different playbooks. You've got value investors, think of them like bargain hunters, looking for solid companies that just seem to be on sale. Then you have growth investors who are looking for the next rocket ship, companies that are expanding at lightning speed. An S&P 500 index fund? Well, that conveniently gives you a nice mix of both. So, how do you invest consistently without getting all emotional about it? Well, there's a simple, brilliant strategy for that. It's called dollar cost averaging. All you do is invest a fixed amount of money on a regular schedule. Say $100 every month, no matter what the market is doing. This takes the emotion right out of the equation and stops you from trying to guess what's going to happen next. All right, now it's time to talk about what not to do. Seriously, understanding these common mistakes can save you so much money and stress down the road.
The number one killer of investment returns is emotion. It's just human nature. When the markets are tanking, our first instinct is to panic and sell everything. And when they're soaring, greed kicks in and we get FOMO and want to buy at the very top. I mean, imagine you invested in 2007, right before the big financial crisis. You would have watched your investment just plummet. But if you had just held on, you would have not only recovered everything, but seen your money grow 4 times over by today.
And that leads us right to the second big pitfall, trying to perfectly time the market. I'm telling you, almost nobody can do this consistently. It's a fool's errand. The key isn't timing the market, it's time in the market. The longer you stay invested, the more you let that compounding magic work for you.
And this chart just powerfully illustrates the cost of that mistake. The research is shocking. It shows that if you were invested for the long term, but you missed just the 10 times best days in the market, your returns could be slashed by as much as 66%. The market's biggest gains often happen in these short, totally unpredictable bursts. The only way to catch them is to just stay invested.
Okay, we've covered a ton of ground. But now it's time to turn all this knowledge into real action with a simple, concrete plan.
First things first, you do not need a lot of money to start investing. So many people think you need thousands and thousands of dollars, but that's just a myth. You can open an account and start your investment journey with $100, sometimes even less.
So here it is. This is your launchpad. Step 1, choose an online brokerage. This is simply the account that lets you buy and sell investments. Step 2, fund your account, which is as easy as transferring money from your bank. And Step 3, buy your first fund. And a low-cost, broad market index fund is a fantastic first choice.
You now have the map, you have the tools, and you have the strategy. The journey to building long-term wealth doesn't require a stroke of genius or a ton of cash. It just requires taking that first small step. So the only question left is, what will yours be?